On Business Incorporated today. It's day 2 of the Nigeria Island Trade and Investment Summit in Dublin. We'll take a look at the economic impact after Zimbabwe Central Bank hikes interest rate to 200%. And Egypt gets a new administrative capital. Thank God it's Friday. Welcome to Business Incorporated on Channels Television. I'm Ini John Mekwa. Well, we start off as usual with market numbers, starting with Africa, where sentiments were mostly positive as intraday. Nigeria's NGX is in the green, though marginally, but at least it's in the green. South Africa's index took a bigger rise, up 0.2%, and Egypt's equities market closed on Thursday, but did not finish trading in negative territory, even though Kenya continued a positive run-up, 1.34% to close yesterday. So the Middle East, where major equities were negative also at intraday. In the United Arab Emirates, the Abu Dhabi index was down 0.32%. Dubai was also in the negative territory and still within the region. Saudi Arabia and Qatari exchanges, which are closed today, were negative at the close of trade, as both indexes lost 1.74% and 0.37% respectively. Now let's go to that event which is going on at Dublin. The Nigeria Island Trade and Investment Summit is day 2 now, and we do have our correspondent Juliana Olayinka. She joined Business Morning earlier, and now she's also there, of course, but she's going to bring us Mrs. Ijeoma Obiegu, Ambassador of Nigeria to Ireland. Obiezu, I beg your pardon, sorry about that, Mr. Obiezu. Good afternoon. How is Dublin at this time?
Well, Dublin, thank you for having me. Dublin is fine. As you can see at the background, it's summer now, so everybody is enjoying Dublin now. It's not very cold.
So this summit, this is the maiden edition of the summit, the Nigeria Island Trade and Investment Summit. What is the objective? What do you hope to achieve with this?
Thank you for the question. Like you said, I'm the ambassador of Nigeria to Ireland, of course, with concurrent accreditation to Iceland. My assignment is simple. I have the mandate of His Excellency, the President of Nigeria, Muhammadu Buhari, GCFR, to look for ways of deepening bilateral relations between Ireland and Nigeria. So basically, I am on it, and that is exactly what I'm doing. Currently, there is a trade deficit, and it's tilting to the advantage of the island country. So I'm looking for a way to strike a balance between that by bringing on board some policies that can help Nigerian products and Nigerian businesses, come across the border to do business with Ireland.
When you talk about the trade deficit, we do have this with a whole lot of countries, and balancing that, what are the specifics? What areas are you looking at? And what areas do you think will come out of this summit?
Yes, Nigeria is a very big and vast country, and we are blessed. Honestly, we are blessed by God in all ramifications. So we are looking at so many things, but to be specific, we are looking at our bilateral agreement as regards border, doing business across the border. That has not been tidied up. To bring Nigerian businesses or Nigerian products to Ireland is like a Herculean task at the moment. But in this summit, as I speak with you, I have a high delegation at the ministerial level, both from Ireland and from Nigeria. We have MDAs, we have parastatals who are here to, come together and strike a balance on how these things can go across the border in the areas of aviation as well, and mostly agro produce from Nigeria. We have a lot of good products. So we are looking for a way, they will always complain about the packaging, the quality and all that. You know that most times that is politics. They are trying to play politics with our products. So we are putting our hands on the table to say, tell us what the product, what the quality should look like. We will package it in that same direction and bring it on. And peradventure, we have some of our businesses who would want to do business with Irish community, in the areas of pharmaceutical, IT, education. They're already doing education as regards an island, like I said, have always been the beneficiary of these businesses. So we want to really come on board to strike a balance, to get something for Nigeria. Let there be something on the table for Nigeria and for Nigerians.
So when you say, especially the agro products, would the targets there be Nigerians in Ireland, or would it be Irish? What's the target market?
The target market, we have a very large African community here. We have a large market of Asian community here. And it may interest you. They are beginning to like our food, especially the jollof rice. So there is nothing wrong in bringing our products. If you have not tried it, you may not be able to say, oh, you like it or you don't like it. They should open up the market for us, and that is what we are asking for. That is what we are demanding from this summit through the high-level ministerial delegation. Open up your market, give us what the standard is, tell us how to do it, and we bring it in. As we speak, Nigerian community alone in Ireland is over 30,000 in population. So, and other African countries here. And we have similar food, we have similar cuisines, we have similar products to share. So our products coming into Ireland will not only be consumed by the Irish citizens, but the other nationals who are in Ireland.
All right, Mrs. Ijoma Obezu, Ambassador of Nigeria to Ireland. I'm very particular about that jollof rice you talked about. I know it to sell there, but thank you so much for your time, and I wish you successful negotiations there in Dublin.
Thank you, my pleasure. Thank you, my pleasure. Thank you.
Well, that was thanks to our correspondent who is live on ground there, Juliana Olainka. She will certainly give us a fuller package at the end of that summit. Now, moving on to Europe, it's been the worst first half-year performance for global share prices on record. European markets weren't spared the pain. Shares in Frankfurt, London, as Juliana has always been telling us, Paris, they've all seen big losses this year amid growing fears of recession, especially in the last quarter. We'll have Stephen Bursley now, who's been on this week, coming to tell us, Stephen, how bad has this year's performance been so far in Europe?
Well, if you look at the Stock 600, that is a pan-European index of large-cap companies, it's down almost 19% this year so far. That roughly matches what we're seeing in the U.S. with the world's largest index, the S&P 500, down more than 20% this year. Come over here to Germany in particular, Frankfurt, the leading index there, the DAX, is down 19% as well. So you can see some big losses right now throughout this period. On Thursday, it was chip makers in particular who were being hit very hard across Europe, and that came after a negative outlook from a U.S. chip-making company based on the expectation there will be less spending in the economy, and that drove down chip makers across the board. However, it's generally those companies that are considered to have heavy exposure to a recession, to reduce consumer spending. Think of those companies that sell automobiles, those that sell products, consumer products, and those that sell travel services. Those are all seeing losses right now. The one bright spot, at least these companies are hoping for, the one safe haven they're looking towards, is China as it begins to come out of some of its more draconian COVID restrictions, though it remains to be seen if that will be the case.
So we do have the COVID sentiment still permeating, and of course we do have the war which is still ongoing in Russia. Is that all about it? Why does it look like investors are so pessimistic?
of recession, that there will be less consumer spending in the economy, and that means that it will come at the expense of businesses. There have been a lot of recent reports that underlie and support this idea that it's going to be tighter. One, of course, inflation. Many of us are experiencing that every day. Prices are rising for energy, for food, and that is forcing more people to keep money in their pocket. Consumer confidence is falling. We've seen the latest report out of the U.S. suggesting, for consumer spending, suggesting that more people are keeping their money in their wallets than they are spending it. On top of that, there is a war in Europe, which we don't know where that's leading to, but we know that so far energy prices have been high. That has added a multiplier effect on inflation in Europe, and even further abroad with commodity prices. So that is a concern as well. And central bankers are responding to that by raising interest rates. That makes it more expensive to borrow, and that makes it less likely that companies are going to borrow at the same rate that they would have before. So all of these taken together mean that it is something of a gloomy outlook for the days and weeks and months ahead.
Yeah, thinking about the months and weeks ahead, what's the forecast?
I think everyone's going to be watching inflation first and foremost. What's going to happen? Will those prices begin to fall? Will there be something of a temporary effect that begins to change over the months ahead? Remember that much of the inflation in the U.S., for example, a good bit of it is driven by the very generous stimulus policies over the past year as the economy tried to get out of its corona slump. So there's more hopes that there will be a transitory effect there. In Europe, it's a different story given what's going on in the Ukraine. So that will be something to watch. We can also expect that there will be those investors who want to buy the dip. They'll believe that that many companies are being undervalued and that they're being sold off hastily. So you will see some buy the dip, though there seems to be a general broad sentiment that things aren't going to be better anytime soon, and the recession could indeed be on the horizon. We expect stocks to fall today across major European indexes, completing what's been a very difficult month and a very difficult quarter, and frankly, a very difficult year so far for most global exchanges.
Yeah, well, difficult year so far. Stephen, thank you so much for that, and enjoy your weekend. Let's move to the U.S. now, where stock futures slipped this morning after the S&P 500 closed out its worst first-half performance in decades. Futures tied to the Dow Jones Industrial Average traded 41 points lower. S&P 500 and Nasdaq 100 futures fell 0.43 and 0.57% each. We'll have Mario Bird with the details of Thursday's trade.
The U.S. stock market had a volatile day on Thursday as it closed the second quarter of 2022 down. The S&P 500 had its worst first half of the year since 1970. It is clear that many investors are skeptical about the stability of the U.S. economy and the U.S. stock market. The Dow Jones was down by 0.81% on Thursday. The S&P 500 down by 0.87%, and the heavy tech Nasdaq was down by 1.33%. The chairman of the Federal Reserve Bank, Jerome Powell, has stated that his number one priority is to stabilize inflation. He is less concerned about increasing interest rates. That is going to be a hard feat as the U.S. economy has a downward spiral, which looks as if it's potentially heading into a recession. Investors are going to continue to watch, but there's very little hope for what will be in the beginning of the third quarter for 2022.
Well, from Europe to the U.S. doesn't look good at all as we look ahead to the third quarter, but we'll just keep our fingers crossed and hope for the best. Moving to Asia now, markets reversed earlier gains and fell on the first day of the new quarter as investors digested positive factory activity data from a private survey in China. The Nikkei 225 in Japan fell 1.73% to close at 25,935.62, and the Topix declined 1.38% to 1,845.04. Fast retailing slipped 4%. In South Korea, the Kospi also reversed course to fall 1.17% to 2,305.42, and the Kosdaq was 2.14% lower at 729.48. Australia's S&P AX 200 declined 0.43%. MSCI Brothers Index of Asia Pacific shares outside Japan fell more than 1%. In the oil space now, prices edged up earlier today after sinking in the previous session, as OPEC Plus said it would stick to its planned oil output hikes in August. Investors worry about the strength of the global economy. Brent crude futures rose 83 cents to $109.86 a barrel. WTI crude futures for August delivery rose 70 cents to $106.46 a barrel. And prices fell around 3% yesterday. We'll take a break now. After that, we'll come back to continue with the program, staying on the African continent. This is Business Incorporated on Channels Television. You're welcome back. You're still watching Business Incorporated here on Channels Television. We're starting with Zimbabwe, where the central bank has raised its main policy rate to 200%. That's the highest in the world for the southern African country, struggling with soaring inflation. Annual inflation has more than doubled in 2 months to 191%. For June, fueling fears of a return to the hyperinflation that has wrecked the country's economy. Well, Zimbabwe has been in a deep economic crisis for more than 20 years, including a withdrawal of international donors because of unsustainable debt. Well, to help us put a perspective to this, we have Matt Kindiga joining us. Hi, Matt. Good afternoon.
Hi, good afternoon. Thanks for having me on the show today.
Great. So, I mean, this is a question I've asked, not just for Zimbabwe. How effective is this interest rate hike in taming inflation?
So that's an excellent question, and this is a question that's being asked around the world. You know, will more hawkish monetary policy by central banks be effective in containing inflation or preventing an inflationary spiral? In Zimbabwe's case, the short answer is it's not going to be very effective, unfortunately, despite the fact that interest rates are now the highest in the world. And this is because inflation in Zimbabwe, particularly in Zimbabwe, is supply-driven. So the inflationary pressures we're seeing are a result of very high global cost pressures, namely food and fuel, as a result of the Ukraine conflict, but also because of depreciation of the currency and foreign currency shortages that we've seen in the country over recent years, but which have become a lot worse since August last year. So in Zimbabwe, what we're unlikely to see is higher interest rates pull down demand. So even if this was a demand-driven inflationary surge in Zimbabwe, the very sharp increase in interest rates would not be particularly effective in reducing inflation. And this is because the transmission mechanism in terms of reducing demand and investment is not really there, or not very effective in Zimbabwe, because credit markets are not very well developed. So certainly we don't expect to see a significant reduction in inflation as a direct result of this increase in interest rates.
But I mean, in the face of this high inflation and rising interest, what's driving the economy at this time?
That's a very good question, and we are certainly expecting inflation, or the return to sort of close to hyperinflation, to negatively affect consumers and businesses in Zimbabwe. In terms of spending, we're likely to see them tighten their belts quite significantly. And we are also quite concerned about the effects of weaker remittances from South Africa. So there are several, or estimated to be several million Zimbabweans working in South Africa, and they do support the economy by sending remittances. And the weak economic outlook for for South Africa is quite concerning for Zimbabwe in this regard. But we do see a couple of things still driving growth despite these challenges. So the mining industry is a real bright spot for the Zimbabwean economy. We have seen quite a number of investments into new mining capacity. A number of mining companies have been raising production in the market. We're also going to see the country benefit directly from the increase in global commodity prices and metals prices. And so this will support exports and government revenues to an extent. And we've also seen an improvement in agriculture productivity and revenues from the sector. And this is very interestingly a result of a switch by a large number of farmers from tobacco farming to cannabis farming. So it's now legal for farmers in Zimbabwe to privately farm cannabis, and it's a much more lucrative crop than tobacco. So we're certainly going to see some benefits there. As a result, we expect the economy to grow by about 3% this year. So despite some of the headwinds.
Yeah, and it's election year there. How much impact does that have in all of this, and how does that affect the outlook?
This is, we're looking at a number of elections coming up over the next couple of years, and we're quite concerned across sub-Saharan Africa. But in Zimbabwe's case, the country has a particularly fraught experience with elections, and there's often social unrest and clampdowns by the government. We expect this to occur again in 2023. So there is likely to be a heightened period of uncertainty and negative consumer and business sentiment as a direct result of the election. The interesting question is what the result will be. So we expect it to be a lot closer than many people think. And this is because in several by-elections and local elections earlier this year, the governing ZANU-PF party actually lost a large number of seats, and the opposition CCC actually made quite a significant number of inroads into previous ZANU-PF seats. So what we're likely to see is a much more closely fought election, but the government is going to be much more anxious about potentially losing some power or some of its seats. And as a result, there's likely to be a bit of a clampdown against the opposition, and this could cause some investor anxiety. So a lot more uncertainty in terms of the outcome and the impact of the election next year.
Yeah, I wonder why elections have to come with a lot of uncertainty. But thank you so much, Matt Kindiga, practice leader, Sub-Saharan Africa with Front of You. Enjoy your weekend.
Thank you, you as well.
Well, moving on now, Spain has accused Algeria of blocking almost all bilateral trade operations, with the exception of its gas exports, following a major diplomatic spat linked to disputed Western Sahara. Earlier this month, Algeria suspended a cooperation pact with Spain, prompting a truce rebuke from Brussels, which warned that there would be consequences for any discriminatory treatment, in quote, of an EU member state. At that time, Spain expressed concern after a key Algerian banking association urged its members to restrict business ties, but Algeria's diplomatic mission to the European Union poo-poohed the idea as a Spanish fabrication. And as Europe seeks to wean itself of Russian natural gas, Algeria, Niger, and Nigeria have revived decades-old multi-billion-dollar gas projects. The Trans-Saharan gas pipeline could send up to 30 billion cubic meters of gas per year to Europe from Nigeria to Algeria and on to Europe. However, analysts note that the project faces many challenges. Nigeria's Petroleum Minister, Timi Silva, said funding for the projects will come from Europe and that authorities are already holding talks with European firms and countries. The Bank of Namibia and that of Angola have agreed to collaborate on various fronts to further their respective price and financial stability mandates, as well as execution of strategies to modernize national banking systems. The excellent bilateral ties between the two neighboring countries have cultivated a long-standing alliance between the two central banks, which has resulted in increased cooperation. In this regard, the two central banks are following the lead of their respective governments' promotion of the free movement of people, goods, and services, in addition to their standard peer-to-peer cooperation. Egyptian government officials confirmed plans to move to the new administrative capital. Head of the Central Agency for Organization and Administration, Saleh El-Seki, said that government is adopting professional plans to move to the new capital and has developed a guide to implement its goals for the transfer of various ministries and government agencies. The new administrative capital is located 75 kilometers east of Cairo, with several projects worth around $300 billion. The President Fattah al-Sisi said that the new region was the birth of a new state and republic. He explained that the government had been centrally restructured, where the ministries or agencies and some bodies have been merged to restructure the state's administrative apparatus. The Egyptian cabinet held its first preliminary meeting in the new administrative capital last December. That's it for today and the week. Thank you so much for being a part of it. Enjoy your weekend. I'm John Mekwa.